Thank you very much indeed, Matthew. Now, on the maxim that the customer is always right, then the question, what do LPs want, is logically the most important question for this industry. To answer it, it's my enormous pleasure to welcome Dana Haimoff, Portfolio Manager, JP Morgan Asset Management.
Cheers. Okay. Thank you, Tim. Good morning. Thank you very much, Tim. As a fiduciary of our clients' capital, I spent a lot of time thinking about exactly what our LPs want, and was delighted when Tim said, could you speak about it? And my initial gut reaction was, well, that could be simple, because what they want above everything else can be clearly reflected perhaps in this iconic scene from Jerry Maguire. Screaming down the phone, many of you have been, yelling at a GP, or speaking to them nicely as it is today, asking to have them show us the money. But as we saw Matthew exhibit, a lot has changed over the last 30 years. I've been investing and advising private equity for the last 25. And what's really important is obviously returns for our clients. We target a return in excess of a public market benchmark. That's one of our prime objectives. But it's also some other things. So what do LPs want? And here's a list of, a dozen or so. I'm sure you'll grab me at coffee morning and say, but you forgot about this, or, oh, I don't care about that. But anyways, just to summarize a little bit, to set the context for what I'd like to talk to you about today, is what LPs want is different. Not one size fits all, as many of you GPs will know. And what we want and the dynamics of how we're trying to get what we want is changing over time, particularly in the market in the last 10 years. So things like track record, how we slice and dice and look at track record. Sourcing engine, you heard Matthew talk about this value creation, and I think that's really important, how you're driving the underlying portfolio companies, as well as how you're driving the underlying private equity firm that we're going to invest in. Lower fees, co-investment, ILPA. A big one that's important to myself and to JP Morgan is ESG and diversity. How are you bringing the biases? How are you changing the biases? How are you creating a culture within your firm to make better decisions and hence drive better returns? There's a whole list here, and some of you, these will resonate more going forward. But I thought as we can maybe take a pause where we are in the cycle, not that we're trying to be Howard Marks and time these cycles, but if we were to look forward to tomorrow, how would we like to look at our portfolio? How do we know what we want? And maybe a good place to start by is thinking about how we recharge, reassess, and replenish our portfolio. And so to start that kind of conversation, I thought it would make sense to look at where we've come from in the last 10 years. When I look at this slide, I take a big breath. I think, wow, we've been busy. All of us have been so busy. And we only invest probably on average about 1.8 billion to 2 billion every year for the last 10 years. And in particular in Europe, we're definitely not a volume shop. We kind of do 4 to 6 things across private equity, fund commitments, secondaries, and directs. But we still have been super busy because we like to look at everything, as I'm sure you have as well. And what this also says to me is, obviously there's a lot of money, but firms are coming back quicker. A lot of times, given the bump in 2008, it took a lot of private equity groups 5 years to invest the capital, sometimes 6. Today, we're finding a lot of funds coming back very quickly within 3 years, 3.5 years, 4 years. And the processes of which all of us LPs have to make investment decisions has changed. There's a lot more systematic processes in place, how we do due diligence, how we're allowed to do due diligence, the time it takes us to do due diligence. These one and done funds, are fantastic and it's super norm. On the other hand, you really have to make sure you're being a true fiduciary and doing that required due diligence within a more compressed amount of time. Underscore of where are we in the environment right now? Where are we in the cycle? Prices are higher, but we can't expect our general partners to sit on their hands. We can expect them to be lumpy and disciplined, of course, but they have to figure out how do they create value in an environment that's more expensive. I've been at annual meetings, and it's annual meeting seasons, and the number of deals I've seen at the 12 to 14 times, it's like they're the new 10 times. But back then, a few years ago, the 10 times was the new 8 times. So some of it will work out and some of it may not work out. So this is the environment of which we've been investing and committing in. So if we were to take a break and take a breath, look towards tomorrow, how would we as LPs, what do we want? How would we want to recharge our existing portfolio? Have we done too much of a certain type of fund? Have we done too little? When we look, are we at our target allocations right now? How do we think about what that construction looks like? Do we have more risk? Do we have FX risk? Do we have more risk we can't control? Or do we have the ability to do more names or less names with more capital? These are all questions that I'm sure a lot of you, such as ourselves, ask. And when you're super busy and you're just kind of working forward the calendar to re-up with existing relationships, sometimes these things could be put on in the back burner. So bringing it forward, how do you recharge? A lot of what we do is in funds less than $1 billion. So 80% of our private equity commitments, whether it's venture capital or growth or buyouts, is in funds less than $1 billion. And the reason why we do that, and we've been doing it for the last 25 years, is because we think there's more return. There's more risk, obviously, but more opportunity to drive returns. And a lot of our relationships that we backed 10, 20, 25 years ago, we have to ask, have they outgrown us? They've been super successful, and we have enjoyed that relationship, and our clients have benefited from those relationships. But have they gotten too big for what we're trying to do? And therefore, we have to really spend time in the less than $1 billion size funds because we believe there's more levers to pull, more value to be created. And that takes time. When we think about recharging, we also think about reassessing. Have we made the right decisions? As I mentioned, have those funds outgrown us? What are we looking to do? What do we want? Do we want more co-investment? Are we more focused on value creation? Are we more focused on sector focus? Are we more focused on emerging markets? There's a lot of questions that we ask because we're super opportunistic. We don't have geographic buckets to fill. We don't have sectors to fill. We don't have stages to fill. So it's completely opportunistic, which on the one hand makes your funnel super big, and on the other hand, it creates a lot of opportunity and makes it super fun for someone in my shoes to go out and find the new thing. As we think about tomorrow, one of the few questions I asked a few of my fellow LPs is, what do you want from tomorrow? What do you want as an LP from your general partner? And while everyone had lots of different comments, the one kind of common thread is they said, Dana, I want them to be disciplined. And you think, okay, disciplined, how disciplined? And a lot of them said, I want them to be thinking about tomorrow and the next day after that. I want them to think about where we are perhaps in the cycle, where we are in this context of we've had what I call a gilded age of distributions. I mean, the last 3 to 4 years, I don't know about your portfolios, but we have definitely benefited from the general partners and all their hard work. So where are we, and who is really thinking that this will either be a continuation of the next 5 years or something will happen? Now, most people you talk about think it'll come to an end. I don't know how. There will be more volatility. And so we like to beg the question of our GPs, well, how are you dealing with this? More sustainable? More sticky businesses? Matthew talked about software. Some of the benefits of software are the subscriber model, and that it's very sticky. How are our general partners thinking about tomorrow in terms of how disciplined are they? And not only disciplined in terms of their investment judgment and the portfolio at hand, but also to their firm. Are they investing in enough resources? Are they aligned in terms of, as we know, a lot of money has been made. The GPs who have done well are far, far richer than they were 10 years ago, 5 years ago. Does that matter? How does that change the culture within a firm? How does that change the investment decision of these partners? Are they becoming more risk adverse? Are they in the risk preservation or risk capital? And sometimes these questions are really hard for someone like us to really get to the bottom of, particularly when we have a short window of opportunity to make a decision that will last us the next 10, 12, 15 years with a given fund. So it's important to maybe, as an LP, to sit back and maybe ask a question about, am I being contrarian enough? Am I being opportunistic enough? A lot of times we want to back people who we say won't embarrass us. But is that embarrassment only a mediocre return in exchange for that safety net? It's really important, I think, to ask yourself these questions, ask your ICs, and ask your underlying general partners who you commit to, how they're thinking about tomorrow. And with that, how do you replenish your portfolio? You know, as I mentioned, we've all been busy. We've made sure we've got the right allocation, and we've been able to co-invest alongside our general partners. We've been able to be good partners to them along the lines. So how do we replenish what we have? Do we need to replenish? Do we need to weight things in light of the market, even though we're not market timers? One of the things that we do, we spend a lot of time looking at emerging managers. Now, the benefits of looking at emerging managers is, and I mean first-time funds, not necessarily first-time investors. There's a big difference. A lot of our success in our own portfolio, we're backing people who had had distinguished careers at some of the larger buyout funds who kind of figured out something, whether it's they want to own something or they see doing a deal in a particular way, or they bring a certain expertise to the table, certain sector focus, and coming together and starting a new fund. And so we spend a lot of time with those people. And that takes time. Those aren't one and done funds by any stretch of the imagination. Those are often 2 year, 3 years where you're sitting there looking at a co-investment. There was one example, we backed a group, they did a small fund, a very concentrated fund. I think we looked at 8 co-investments with them up until the time we backed them in this smaller fund vehicle. So they take long, but at the same time, you really get to understand the partners, the people, what's driving their investment judgment, how they're going to drive value, and how they're going to source opportunities. And that's a benefit we found have really worked well in terms of our portfolio and longevity in backing certain managers. And the other one is somewhat obvious. It's about the look. It's about taking the time to really look deeply and do the work and do the due diligence that oftentimes will have to happen outside of a process. I always say the best time to be working with a general partner is when they're not fundraising. Everybody's just a little bit more relaxed, so to speak, maybe not as shiny, not as polished, a little bit more open to the idea of going on that longer journey with them. We still make mistakes. We still commit to funds maybe we shouldn't have. We still are maybe a little too optimistic in this market as well. But I think just having this moment to kind of recharge and reflect allows you to kind of think about where we're going to be tomorrow. So with that, I would like to say thank you for your time, but also as you sit here and listen to speakers, as you debate and challenge some of the panelists, as you network, maybe you'll take a moment to think how you can recharge your own portfolios and think about tomorrow in the context of the next 5 years will probably likely be a bit different than the current 5 years that we've all enjoyed in private equity. Thank you very much.